Guys, what is going on? I'm doing a Tax Tuesday live. This is where I just answer basically questions in the chat and talk about tax season. So there's three things that I want to talk about today that will basically help business owners save more in taxes, prepare for the tax season coming up, and save more money and build systems within their business. So today, and I'll be looking at my chart here. So if I'm looking back and forth, you guys know why. So I'm talking about tax planning time. When is basically the deadline, the internal deadline to do some tax planning before it's too late and you end up overpaying the taxes? Then I'm going to be talking about common tax deductions. And then I'm going to be talking about how do we do this accounting stuff? Why do I need accounting in my business? How do I go about doing accounting? And why do I even need it, right? So that's what I'm going to be talking about. And if you have any questions, put them in the chat. We're going to answer them in real time. Okay. So Tax Tuesday, guys, it's Tuesday. So this is what we're talking about. So tax planning time. When is the correct time to do tax planning for your business? Or when is it basically the last month where I need to start doing tax planning, right? So each year is when you have to do a tax plan. This is something that you do each day, each year, for every year that you're in business. You should start in January, but for my late tax planning people that want to do it last minute, I would say the end of August is when you need to reach out to your CPA, sit down with them, schedule a call, and basically say, hey, I need some tax planning. Or does my business even look like it needs tax planning for the year? The first thing your CPA should do is look at your QuickBooks, look at your financial statements. They're going to pull your financial statements. They're going to pull what they call a profit for loss by month, and then they're going to forecast all your data and project it for basically for 12 months to get a projection of how much you should be owing. They're going to take your revenue minus your expenses, and it's going to equal your taxable profits. That's what we're taxing on. They're going to usually probably time it around 30%, but they're going to take that number, take your taxable profit, times it around 20 to 30%, maybe more, depending on your tax bracket. And they're going to give you an estimate tax owed or estimate tax liability of what you owe. And maybe 30,000. I recently did one today where he was owing 28,000. So I told him, hey, you got two choices. Either save a plan to save for this 28,000, or let's develop a plan to reduce that 28,000 tax liability. My whole goal, especially in my firm, is to make sure we're not overpaying in taxes and using tax strategies to make sure we keep your money basically within the business and not to the government. That's the whole goal. With tax planning, I want to make sure the money is spent with the owner and the business rather than the government. I want to pay them their fair share and leave them alone, right? So the latest of which you should be reaching out to your CPA is, I want to say, the end of August, no later than the end of September, because you want to give your CPA enough time to properly do the tax planning. You don't want to rush it in the last month of December. A lot of business owners try to do tax planning in December, and it ends up basically having them pay more, charge more, because the CPA has to charge for overtime work, and you may not be able to implement all the strategies. A lot of business owners try to do it in December because that's when, I guess, you know where you should be landing at, in regards to your tax situation, I believe. But you should be doing it no later than the end of August, right? And tax planning is simply coming up with tax strategies to reduce your tax liability. So let's talk about a couple of them. One of my favorite ones is, of course, I know my followers are getting sick of me saying this, the Augusta rule. That's one of my favorite ones because it's just so simple. You're renting out your personal home and your business is paying you for it. There's a certain way we have to document this, but basically all you're simply doing to keep things simplified is you're moving money from your business account over to your personal account and labeling that transaction as a meeting room expense. Now, granted, we have to document this properly. We have to draft some contracts in basically a rental agreement. so we can successfully prove this against the IRS. But that's all you're essentially doing. You're taking money from your business, and each time you have a meeting, as long as it's under 14 days out of the year, you're paying yourself for it. The only difficulty is documented property. That's when you will reach out to your CPA and say, hey, can you help me with this? And they're going to charge you for what we call tax planning. A second one is looking at your entity. A lot of business owners are operating under the wrong entity structure. And when I mean entity structure, that means LLC single member, multi-member LLC multi-member partnership, S Corp, C Corp. Most people aren't under the right entity that are going to save them the most amount of money when it comes to taxes. For example, I was speaking with someone today who owed $28,000, $15,000 worth of that tax saving. He owed $28,000, and we actually found tax savings up to $33,000, I believe. $15,000 or $16,000 of that was strictly $15,000 and $16,000 of our tax savings were strictly because we're switching his entity. His profits were too high. He's in the physical therapy space. He has no expenses. His profit margin was too high. It was at 86%. And when I say profit margin, that means for each dollar that you make, you're bringing home that profit margin. In this case, his was 86% profit margin. So for each dollar, he takes home 86 cents and only spends 14 cents, right? That's profit margin. You want a higher profit margin because you want to bring home more of your money that you make out of the dollar, if that makes sense. So he's in a high profit margin industry, and he was a startup. So he doesn't have too many expenses. He doesn't have salaries or rent or anything. So we had to come up with a way to help him save money in taxes. I think he had over $70,000 worth in profits that we forecasted. So with our little projection, we did 70,000 of taxable profits, and we did it against a 24 tax bracket. So that I think he was higher than that, but for that case, he was looking at owing 16,800. But his profits were higher than that. I just can't remember off the top of my tongue. But he was taxed on his profit. Our job was to basically create a tax plan for him, and we found out we can save 16,000 just by switching his entity. So that's what we're doing, right? So Augusta rule is something that you need to look at. Your entity structure is something that you need to look at when it comes to taxes, and you need to basically look at how much you're paying yourself to as well, or how much you're paying your employees, right? All those things matter when it comes to you paying money in taxes, okay? So that's a little bit about tax planning. For the next part, I want to move over to the tax deductions, right? A lot of business owners do not know what they can write off when it comes to taxes. And my answer for all the years I've been in the tax industry, the tax and accounting industry, is always you can write off everything as long as it's ordinary and necessary for your business. As long as it's ordinary and necessary for your business. So say if you run a medical clinic, what's ordinary and necessary for that business? Supplies, employees, staff, contract labor, anything that's necessary and ordinary. And if you are curious about that or want to know how to make something ordinary and necessary, this is the time where you reach out to your CPA, have a consultation, say, hey, I've been looking to write off some of my travel. How would I make that ordinary and necessary for my business? I would tell you, okay, you're in the medical industry, you own a medical clinic, and you want to write off your travel. How can we make that ordinary? And we're talking here, right? We're doing a little role play. How can we make that ordinary and necessary for our business? We travel based on the seminars that we go to or the education workshops that we go to based on our industry. So if you have a workshop or a seminar in California and you live in Texas and you're looking to write off that travel because you actually want to go surfing in California, I will basically base my trip and make it a business trip by finding seminars or workshops in that area where you want to do your surfing or where you want to do your vacation, and base that travel around that seminar. I will book it on a Monday so I can basically come in Friday, Saturday, and I will do basically business activities while I'm on that travel. Granted, you don't have to do business activities for the whole day. Make it 50, 60% of your day where you're doing business activities. And you should be okay when it comes off writing this stuff off on your taxes. The name of the game is we want to make it ordinary and necessary for our business, and we want to document this stuff, these tax write-off. So if the IRS ever comes knocking on our door, we have valid proof of why we went to California for that vacation or that travel trip, and we can properly defend our case. Now, if you don't have this record proof, you end up not able to claim that as a business write-off, and then you end up having higher profits, and you're going to be taxed on that profits, right? So as long as we're making tax write-offs ordinary and necessary, we can write off almost anything that makes sense for our business. Okay? So that's tax planning. That's tax deductions that we just talked about. Now I want to talk about, why do we even need this accounting stuff? Why is my CPA or accountant telling me that I need to do QuickBooks? I just want to do my business. I don't really want to deal with this accounting stuff, right? These are questions you're probably asking yourself, because as business owners, we want to operate lean and we don't want to waste money. So the whole purpose of why we need this accounting stuff, why we need accounting, is because it helps us reduce our tax liability. It helps us make important business decisions because we're looking strictly off the numbers. And if we're not looking at the numbers, that means we're blindfoldedly just making wrong decisions, or we're guessing on each business decision because we have no data to go off of, right? And also, it allows us to scale our business, okay? And allows us to get working capital from banks, lenders, and investors. That's the only reason why we need this accounting. From my point of view, I know your CPA or your accountant may say different, but I like to keep things simple. I want to make sure my business owners are organized financially, and they have the power and leverage to go take their financial statements, go to the bank, and get the capital they need to grow their business. Essentially, that is all business owners are simply looking for. I come from a second generation line of business owners, family of business owners. I know what they want. They aren't looking at all the bookkeeping data. They're looking at the high importance stuff. They're making their decisions on whether they need to cut payroll, raise payroll, if they need to open up a new location. They're looking at all that data for those reasons. And then once they use that data for making important business decisions, they're looking at, okay, let's go get another business line of credit to increase our spending power. And they sit on that business line of credit, and they keep refinancing and revolving that business line of credit until they increase their spending power. Now they take that spending power to help grow and scale their business. This is how it's done, guys. This is why we need accounting. This is why it makes sense to do accounting. We want to be financially organized, and we need to leverage our financial statements to basically go get capital. All right. And plus, if you don't have your accounting in order, you're more prone to overpaying taxes, because what are you going to give us at the end of the year? If you give us a laundry list of bank statements, your CPA or accountant is going to charge you more for doing a year's worth of bookkeeping in a span of a couple months. That's hard work. So that's why we need this accounting stuff. And I, do emphasis, because I hear this often within the entrepreneurial space. Like, why do I need bookkeeping? Why do I need monthly accounting? If you seriously want to grow and scale your business, or at least maintain it, so you can know the financial health of your business, you're going to need this accounting stuff. You're going to need accounting. So what's the SOP? What do I need to do to start implementing accounting in my business? The first step is go to QuickBooks Online. I made a video about this. Go to QuickBooks Online. You can start off with Simple Start. Once you pay for the software, it should be $15 for the first 3 months, and then it moves up to $30. If you have your CPA send it to you, you can get it discounted. Ask your CPA or your accountant that. And once you get the software, the first thing you do is link all your business bank accounts to this software, not your personal accounts. If you have a personal bank account, We don't want that in QuickBooks. We don't want to see your trips to Chick-fil-A, unless it's business related, but we don't want to see your trips to Target or Chick-fil-A or to the movies mixed in with your business expenses. It messes up the whole accounting system because we don't know what is what, and we don't know how your business is truly doing. So we don't want to commingle your personal and your business life together. So link all your business bank accounts to that software, all of them. Even if you have savings account, even if you have a checking account with different banks, link all of your business bank accounts under that software. Once you do that, it's going to record all the data. Anytime you swipe that card, move money in that card, it's going to be recorded within QuickBooks. Now, either yourself, your bookkeeper, your CPA, or your accountant will do the categorizing. And categorizing is basically when a QuickBooks transaction comes in. That means when you swipe your card, transaction comes in. We want to know what that transaction is about. Is it a meal expense? Is this income for your business? What is this? Is this cost of goods sold where we're paying labor in order to produce your product? What is it that just came through this bank account? That's called recording your transactions. If you're a startup, I recommend that you learn it yourself because I want you to understand how money moves within your business. Once you understand that, then you outsource it to someone else because I don't want you spending too much time on non-revenue generating tasks. Right? But from the beginning, if you're a startup, I want you doing your own bookkeeping. I want you learning from a CPA first to say, hey, I want to do it at the beginning, and then I want to move it over to you. This is going to help you learn how money moves, and it's going to help you understand the accounting. It's essential to being a great business owner. Once you do that, you're going to get after you record all the transactions for the month or for the year, you're going to get what we call your financial statements. It's a balance sheet, statement of cash flow, and a profit and loss. All of these financial statements either help you get access to capital, and they help you basically decide what decisions do I need to make within my business. Do I need to cut payroll? Do I need to switch my employees over to from W-2 to over to 1099? The financial statements, it's a roadmap to where we need to go. For example, I had a lady in the mental health clinic space. We made a decision that all her W-2 employees needs to be switched over to 1099. We simply cannot afford them. Us switching from W-2 over to 1099 saved her $28,000 for the year. Now she's taking that $28,000 because it was $14,000. Yeah, and then we times about two, so that $28,000. Now we're taking that money and we're going to go find a way to basically invest it back in the business so it can increase revenue. That's where she's at in the state of her business. That's how we use the financial statements to make important business decisions. Without the financial statements, I wouldn't be able to offer that recommendation for her. I would have been like, I don't really know what to do. I don't know where the money is moving within your business. I don't know what's what. So your financial statement, I want you to think of it as a way to organize your business and create a roadmap to your success. And your success is whatever you want to paint it. Okay. So once you get your financial statements, that's what we're doing with it. We're making important business decisions. You're sitting down with your CPA and you're making strategic decisions in order to either scale your business, multiply that's the same thing, multiply your business, or just reduce the tax liability within your business. That's the whole reason why we need this stuff. Okay. And that's building out a system. Adding QuickBooks to your business is building out your accounting system. Okay. So let's circle back to tax deductions. I want to tell you guys more write-offs we can take. We talked about tax planning. We talked about tax deductions. And we talked about building your accounting system and why do we need the QuickBooks. Now, I kind of want to cap this off by just talking about some common deductions we can take in our business, right? So home office is one of the most overlooked tax write-offs that my business owners miss out on. Whether they're a Schedule C, an S Corp, or C Corp, they don't factor in this home office expense, and they're missing out on it. Majority of business owners are working from their home, and they're using their home to basically produce income for their business because that's their office. And home office is basically taking the square footage of your home office and dividing it by the total square footage of your entire home or your apartment, and you're going to get a percentage. Maybe it's 8%, 7% of your entire home. Now, 7 or 8%, depending on what the percentage is for your home office, all of our personal living expenses, our rent or mortgage, our mortgage interest, our utility bills, our Netflix account, that's because we have a TV in our home office that we use for business activities, and any other business, basically living expenses that we have outside of groceries. We can use that. We can use 7% of that total as a business write-off. We were going to pay it anyway. Why not get a tax write-off for it? Right? So home office, you need to tell your CPA, like, hey, I want to take advantage of the home office this year. It's a huge tax saver. And it doesn't revolve you spending money in your business. I love stuff like this. You get to save money in taxes and not spend any to save it. Right? The second one is Section 179. So if you have a vehicle, any large equipment, ask your accountant about Section 179. All that allows you to do is help you speed up the depreciation of that equipment or vehicle, so you can accelerate your that tax expense and write off more in your current year. Take advantage of your Section 179. Take advantage of depreciation on your buildings. It's a must. It's free write-offs. Why not use it? And the beauty of it is, when it comes to lending, banks add back those non-cash transactions back to your profit, therefore making that approval amount, that pre-approval, higher. So you can get inside that first home that you want. So you can make that rental investment that you want. So you can buy that commercial property, because we're taking those non-cash transactions like home office, Section 179 depreciation. We're taking those expenses and adding it back into your profits, making you more bankable, because lenders look at your profitability on your tax returns. That's one of their requirements for some underwriters, of course. So home office, Section 179, home and depreciation are write-offs that we need to take advantage of. I'm not going to hit the head again with the Augusta rule. Y'all guys should already know about that if you follow my page. That's one of my favorite tax strategies. And let's see what else. And you should look at accelerating your expenses towards the end of the year. So if it comes to December and you know you're going to be operating business again next year, and you have the capital within your business to do so, if you have the money within your business to do so, when December hits, I want you to pay in advance all of your following year's expenses and get a write-off for it. So if you're paying rent for the year, for next year, go ahead and pay it all for, or pay some of it for. We're accelerating our expenses. This works if you operate as a cash basis business. Cash basis is, you're operating as a cash basis business, so that when money hits your account, that's when we record it. Go ahead and pay in advance all of your expenses so we can accelerate your expenses. And it's not throwing it away, because we're going to pay this anyway. We're just accelerating it to take advantage of the tax deduction in the current year. These are common tax write-offs that are just easy for anyone to take. Okay. And these are some of the things that we talk about within my company when it comes to tax planning. I may look at your financial statements and say, okay, we already exhausted most of our tax write-offs. We have like 10,000 in the bank account, and this is me talking to you. We have about 10,000 in the bank account. Let's use if we use 7,000 of that, we can save a boatload of taxes. Can we take 7,000 and accelerate some of your expenses? If it works out to save you money in the short term, let's do it. Let's take advantage of it, right? So those are some of the tax common deductions out there. If you have any questions, put something in the comment. If you're curious about something, put something in the comments so we can talk about it. But yeah, this is our Tax Tuesday. Thank you guys for joining.